Hello and welcome back to The Note. It's been quite a week on world stock markets. It's been quite a month. We've seen a number of big landmarks breached. Perhaps most famously, the FTSE 100 in the UK has now reached a first all-time high since 1999. But despite that, despite the fact that we've now had a rally that's gone on almost interrupted for 6 years, since March 2009, it's still fair to say that this is the most hated rally in history. Why is that? Ultimately, because it really hasn't made people rich the way a stock market rally normally would. Not even the people who work in financial services. This is investment banking revenue post-crisis. Normally, investment banks make far more money when markets are high. They have more M&A, they have more placements. This time around, that's been less the case, and as regulators, I think quite correctly, are requiring them to keep a much bigger capital buffer to guard against the risk of crises in future, they are able to make much less in the way of profit. Therefore, even the people here in Wall Street or in the City of London are not really gaining the way you would think from a protracted bull market. Indeed, in part because the investment banks have had their wings clipped, the power and the money is moving over to asset managers. If you take a look at this chart, you can see that asset manager pay is almost at the point of overtaking that of investment bankers. It looks as though it will overtake it next year. So you might think asset managers have been one of the big victors of this, but in fact they haven't. This has been an extremely difficult rally to keep track of. The dispersion in stocks hasn't been very wide. Everything has been pushed up by the central banks, meaning that it's very hard to outperform to pick winners. And as active managers have failed to beat the market, so there has been a steady flood of money out of their coffers and into passive funds, who tends to make tighter margins and pay people less. That applies even to the big sexy alternative asset categories such as private equity or hedge funds. There again, they've found it very difficult to outperform in the last few years, and they're coming under very much tighter scrutiny from the people sending them money. So even asset managers have not really enjoyed this rally. It's been very difficult for them. Now, part of that, again, is that part of the reason that people haven't really profited from this rally is that nobody's truly believed it. You can see that from this chart, which is adapted from Merrill Lynch's regular fund manager survey. Whenever equity managers have more than 4.5% in cash, they regard that as a contrarian indicator that you should buy. It suggests they're being too cautious. You can see that for large tracts of this rally, they have indeed stayed out of the market. That also plainly refers to the many retail investors. This is a good reason to think that the rally can carry on for a bit longer, because there's still more money to be sucked in. But it explains again why it really hasn't made people happy. They haven't trusted it, and they haven't enjoyed it to the full. Why haven't they trusted it? Largely because people think that this is all down to the central banks. This is a chart where we've combined the balance sheets from all of the major developed world central banks. It's not just the Fed. Even though the Fed is beginning to take its foot off the pedal now, that will be more than compensated for by the efforts of the Bank of Japan and the European Central Bank. And you can see that while this rally in world equities is very impressive, it does really seem to owe an awful lot to expanding balance sheets by central banks. There are many people who simply don't believe that this rally is going to survive a normalization of monetary policy. Many of the people who have actually been long stocks, who've bought in, have done so rather grudgingly, in the belief that they don't have any choice. There is a lack of genuine belief that a strong rally means a strengthening economy or a durable rally in equity markets. All of that is a good reason to think that it could carry on further, but that's basically the reason people aren't excited by this. Not only have people in Main Street not got involved, in many cases because they simply don't have the money to put in, but even the people you would think would benefit greatly in financial services haven't benefited. It's just the 1%, arguably. You can see why this rally is hated.